Let's take you live to Sydney now. The Reserve Bank Governor Philip Lowe providing an update on Australia's economic outlook amid soaring inflation and interest rates.
They have in many years. And the tragic events in Ukraine have led to sharp increases in the prices of energy and prices of food right around the world. Interest rates are also increasing everywhere from the record lows that we saw during the pandemic. All this is happening at a time when unemployment rates in many countries are very low and household budgets are under strain in most countries as well. So it's a really complex policy environment at the moment. Today I would like to begin by focusing on the recent inflation data and the outlook for inflation in Australia. I'll then turn to how monetary policy is responding to this higher inflation. And I'd also like to share with you some of the observations from the Reserve Bank Board's recent review of the yield target, which we published at 8 o'clock this morning. This review is one review in a broader set of reviews the Board is undertaking regarding our pandemic response. We want to be open, we want to be transparent, and we want to learn lessons for the future, and I'd like to share some of the observations from that review with you this morning. But before I do that, first to inflation. The rise in inflation is a global story, and you can see this in my first chart. In the US and in Europe, inflation is above 8%, and in some countries, the peak in inflation has not yet been reached. I think in the United Kingdom, we're expecting double-digit inflation before the end of the year. Inflation's also picked up in Asia, although it isn't as high as it is in the North Atlantic. As you can see in this chart, Japan's a notable standout. While inflation has picked up in Japan, it's still only just above 2%. But almost everywhere inflation is at multi-year highs. Australia is no exception to this trend, as you can see, although inflation here remains below that in most other advanced economies. In headline terms, inflation in Australia was 5.1% in the year to March. As you can see, that's the highest rate in many years. In underlying terms, inflation was 3.7%. That's higher than it's been for some time, although it's still lower than it was at the peak of the resources boom. But in both headline and underlying terms, inflation is much higher than we had earlier expected, and it's much higher than central banks around the world had expected. The fact that inflation is high everywhere tells us that there are some powerful global forces at work. During the pandemic, supply chains were interrupted, delivery times blew out, and firms' cost of production increased. Not surprisingly, we're seeing higher prices. And then on top of the pandemic-related problems, Russia's invasion of Ukraine has caused major disruptions to the global markets for energy and food. And as a result, oil prices have increased by a lot, 28% since February, and global food prices, you can see in this chart, have increased very sharply. There's also been very strong growth globally in demand. During the pandemic, central banks and the fiscal authorities put in place very stimulatory policies. So you've seen stimulatory monetary and fiscal policy, which has resulted in strong demand globally at a time of an impaired supply side and prices being pushed up because of the war in Ukraine. So these are powerful global forces. When events like these occur, it isn't possible for us in Australia to insulate ourselves from their effects. We live in an interconnected world, and big shocks in global markets will affect and do affect our markets, and they affect the prices that we pay for goods and services here in Australia. As you can see in this next chart, petrol prices in Australia are up 37% over the past year. That alone is adding 1% or a bit more to the headline inflation rate. So 37% rise in petrol prices, and that's due to global developments. Another example where the disruptions in global markets is evident on prices we're paying here in Australia is the prices of new cars, which you can see here are rising at the fastest rate in many years. And there are many other examples as well where goods that are produced in global markets, their prices are going up very quickly, and it's inevitable that those higher prices flow through to higher prices here in Australia. But as important as these global influences are, they don't provide a full explanation for the higher inflation in Australia. Increasingly, domestic factors are also playing a role. Following the strong recovery in demand from the pandemic, growth in domestic spending is testing the ability of the economy to produce goods and services. This is particularly evident in the labour market, with many firms reporting that the availability of labour is a significant constraint on their ability to operate and to expand and invest. And you can see the results from one of the surveys in this graph here. It's, every business meeting we have at the moment, firms are telling us that it's hard to find workers with the right skills. Many parts of the construction sector are also operating at close or at full capacity, and we've seen some public infrastructure investment being delayed or scaled back because of capacity constraints, either in terms of workers or the availability of resources. So increasingly across the Australian economy, we're seeing evidence of capacity constraints. Not surprisingly, this pressure on capacity has led to a broadening of inflation pressures in Australia, and this is evident in this next chart, which shows the share of the items in the CPI basket with annualised price increases more than 3%. As you can see, that share is the highest it's been in many years. In fact, it's the highest since 1990. So a lot of the elements of the consumer price basket are increasing at relatively fast rates. We've seen a broadening of inflation pressures, and I think that's likely to continue for a while yet. When the RBA published its latest set of forecasts in May, we expected that inflation would peak at the end of the year at around 6%. The information that we've had available since then has led us to push that forecast peak in inflation higher. Since early May, petrol prices have risen further due to global developments, and the outlooks for retail prices of electricity and gas have been pushed higher due to the well-known pressures on capacity in that sector. And as a result, we're now expecting the inflation to peak at 7% in the December quarter. 7% in the December quarter. Following this, by early next year, we expect that inflation will begin to decline. And I'd like to share with you three factors that lie behind our assessment that inflation will decline next year. The first is that some of the pandemic-related supply-side problems in the global economy are gradually being resolved. See this in this chart. Firms have been adjusting to their new operating environment, and they have been solving the problems in global production and logistic networks. As a result, delivery times have shortened a little from late last year. The prices of semiconductors have declined. They're still very high, but they have declined. And the global production of cars, which has been impaired over the past couple of years, is now showing signs of a recovery. So the global production and distribution system is adjusting. As that adjustment continues, you'd expect some of the inflation pressures, particularly in goods, to ease. It's still possible we have further setbacks because of COVID, but the global production system is adjusting, and that's going to help. The second factor is a more technical one, but it's one that's important that we don't lose sight of. It's important to remember that inflation is the rate of change in prices. It's not a concept about the level of prices. This means that for inflation to stay high, prices have to keep increasing at an elevated rate. If prices simply remain high, then the rate of inflation declines. An example of this is oil prices. Even if they were to stay at their current elevated level, the rate of inflation in oil prices over the past year was 66%. So oil prices up 66%. If they stay at their high level, then the rate of inflation in oil prices goes to zero. That mightn't be of much comfort to people who are struggling with the current high level of petrol at the bowser, but it would mean that the measured rate of inflation would go from, I said, petrol prices up 37% over last year to something closer to zero. So it's a technical factor, but it's one that we shouldn't lose sight of. Inflation is about the rate of change in prices, not the level of prices. But the third factor that will bring inflation down is the tightening of monetary policy right around the world, including here in Australia. The higher interest rates will help create a more sustainable balance between demand for goods and services and the ability of our economies to produce those goods and services. Achieving that balance between demand and supply isn't going to be straightforward, and there are risks involved, but the higher interest rates will help alleviate some of the inflation pressures we're experiencing globally and here in Australia.